All right, now let's head on to our next conversation. Well, planning for retirement is becoming quite a task. Right now, we see that it's getting harder with all the macroeconomic headwinds we're seeing at this time, from inflation to currencies being pressured due to high debt level and all of that. So definitely setting out and setting aside for retirement is quite tough now, because you don't know what investment class is going to still remain strong when you're ready to retire at this time. So it's getting quite tough at this time. Let's talk to Abigail Utomi, now business head, asset management, Northern Berger. Great to have you on the show. Good evening.
Good evening, Ladi.
Great to have you. So, as I said, you said what?
I said I'm happy to be here. Good
to
see
fantastic.
You.
Great to have you. Great to see you. And thank you for giving us your weekend. So definitely planning for retirement seems to be tougher, than before. Right now, we're dealing with geopolitics, inflation. Debt is changing the way we interact with, most of these assets. There's pressure on currencies. And we see that the dollar is not left out, as some countries are planning to move away from trading in the USD. How are you seeing, all of this? Because at the end of the day, these assets are supposed to remain strong, going forward. So if you're investing for retirement, you should be able to meet them strong when that time comes.
Absolutely, Ladi. And all of these parameters that you've reeled out is the reason why we should continue to think critically about retirement planning. The macroeconomic space and the local economy makes it quite challenging for the investment banking space and the investing public to cope with the fast movement, in the variables, and as such, making it more necessary for people to move and, realign their investment objectives and their goals, as well as the objectives in terms of achieving them as quickly as possible. I mean, in Nigeria, for example, you're aware of all the latest developments after the change in government, and analyst opinion is that things would even get tougher. And of course, we all need to put our hands on the button and look at how best to do that. And for us here at Northern Berger Financial Group, we're always positioned, to meeting these needs and bridging this gap through our various businesses within the group in pensions. So retirees need to start to look at the quality of their pension assets and how much, the PFAs are able to maximize value from it, in addition to their own deliberate efforts to create semi-annuation funds for themselves ahead of retirement, because you really need to start to critically look at the numbers. Will it take you to where you want to be, in the near or long term? If not, how best do you re-strategize to get there? You and I know that when you plan your finances well, your non-financial atmosphere looks a bit better, because you have rest of mind, it reduces your stress, helps you live a healthier life, and of course increases life expectancy ratio. So all of these things are things that, we need to look at in order to help move us to where we need to be to grow the economy as a whole.
And looking at, investment classes at this time, which one do you think is that investment class that will stand the test of time, the next 20 years, still here, still has value?
Of course, all market segments remains important, but I think that we really need to start to look at currency hedge, and that's why we launched a dollar fund last year to react to that change. We need to also look at the fixed income space, because, of course, as intending retirees or close to retirement, you need to start to seek for stable return on investment, and you would want to move away from highly volatile asset classes in equities. Now, depending on your age grade, you would be open to a more volatile investing up till a certain age where, of course, from an investment advisory perspective, we would begin to tell you to wind down and move away to safer assets that still pose great opportunities for growth, for periodic returns that you can plan with through retirement. Because, of course, you would not want your earnings to be impaired at such a short notice. You would want things to be stable to prevent reinvestment risk. No doubt, you would also need to hold a certain percentage of your funds in money market. The reason being that you would need to maintain liquidity and have some form of contingency fund in case of any emergency situation. That poses a very good plan for you to fall back to if the need arises. So investment portfolios would always be curated across asset classes and even currency divides. However, the proportion to which you would be looking at would depend on your age to retirement and your immediate short, medium, and long-term goals.
Right. Well, we'll continue the conversation right after this break. Everyone's looking for that, great hedge, against inflation. We still have Abigail Lutomi, business head, asset management, Nuremberg. We'll continue the conversation right after this break. Stay with us. Welcome back. Still watching Capital Market live on Channels Television. I still have with me Abigail Lutomi, business head, asset management, Nuremberg, and we'll be talking retirement, planning for retirement and the impact on the capital markets and economy. Thank you for staying with us. So, Abigail, what would you say is the best, strategy to prepare for retirement for those far from retirement? Somebody like me, I feel like I'm far from retirement, and those close to retirement, what's the best strategy?
Okay, thank you, Ladi. The best strategy would always be to start early. From the first day you got your first paycheck, you should start to think about retirement, because you need to realize that you won't work all your life. It is not healthy for you to continue to work hard, all of your life. After that, you then need to look at your current and future positions. Where are you at the moment? What sort of future cash flows would you be having to take you to your destination? All of these realities needs to come into your objectives, and they should be smarter ones. You know what smarter stands for. And then after that, you need to look at the mechanism. How do you get there? Do you know what your risk profile is? How old are you? What investment classes or vehicles would you use to achieve those goals? Again, the reality would always come to play. Things are changing really fast, like we discussed earlier. How quickly are you able, or your portfolio able, to react to those changes in the economy, as it were? And again, you then look at periodically how far you are from set targets and how you need to realign your portfolios to achieve that. A lot of people wake up and start to think about retirement planning too close to retirement. And of course, it creates some form of anxiety towards retirement that is absolutely unnecessary if we start early. Before retirement, you should already know whether you're going the pension, the program withdrawal route, or you're going annuity, not at retirement, right? Because whilst I would not put one over the other, each one would depend on the individual's objective, which way to go. And then understanding yourself in taking those decisions would help you determine ahead of time where you need to be, rather than following the bandwagon. A lot of people follow others in retirement because they've never sat down to think about theirs. And then, of course, you need to start to look at what your pre-retirement lifestyle looks like. How do you want to sustain it at retirement? Do you want to scale down? Do you want to look at alternative ways to increase revenues through passive income, investment income, other business income, if you do have one? Retirement is not the time to start to try new things. So if you have a passion, you should start it prior to retirement, so you make the mistakes early and learn from them. If you haven't done it, please hold on and be where you will be comfortable in, and of course seek financial advice. The pension industry is small because we just have about 10% of the adult population currently above 60 years of age. However, our youth population is a lot. In this case, I'll be batching people from 18 to 60 years, and we roughly have 46% of our population in that space. So you can reflect on how important this data is to the future. It therefore means that very soon we will find that the younger generation would be approaching retirement. How ready, are we to receive these numbers to that space, and how ready are they to be financially free at retirement? we are moving away from the traditional support system in Nigeria. And as such, people need to also start to shift in their planning towards that to ensure that, there is no breakdown and financial dependency at that time.
All right, let's look at the, pension industry now. How much benefit does it bring, to the economy? And looking at, government borrowing right now, we're seeing that definitely, the government's definitely looking for revenue at this time. And even though the government still likes to borrow at this time, how does this pension industry, come into play with government borrowing and economic growth?
Thank you, Ladi. The pension industry is currently, 15.5 trillion naira, accounts for approximately 8% of Nigeria GDP. The borrowing of the government supports as outlets for the pension funds because we're able to invest in some of those assets across all funds. So I would say that it's a symbiotic ecosystem where one feeds the other and the other benefits from the other. However, the more we grow that industry, the more we increase our numbers. Currently, just about 10 million RSA holders out of the numbers reeled out earlier. We currently have about 45% of the population being in the youth population, which means that we still have about 90% that have not been included in the pension scheme. So the PFAs have a lot of work cut out for them. Northern Pensions, amongst others, continue to seek ways to deepen the market, to increase the reach and expand the contribution of the pensions industry to Nigeria's GDP. We will also, through deliberate steps in terms of retirement planning seminars, and coincidentally, one is happening this month, on the 23rd of June at the International Conference Center, which is also a means where the Nigerian public in Abuja and environs could come together once again to learn more about what they need to be doing ahead of retirement and also contribute their quota to the planning and strategy around it.
Right, and definitely 2023, we've seen the first quarter quite tough, at this time. What are you seeing for the pension industry going forward?
It's going to be a very competitive one. People will start to look out for new markets, and rightly so, because there's still a lot more work that needs to be done, and we need to get out of the urban space rather than clustering there, whereas there are a lot of markets in the most informal segments of the economy, so that needs to be banked. The micro pensions, which is the Fund 5, is growing, but it can grow faster than the pace we currently are seeing it. That will show us that a lot of the informal sector is beginning to embrace, pensions, financial sector, and financial literacy as a whole, because it's a way to planning for retirement. And if you're already working in an informal sector where you're not sure of a compulsory contributory pension, then you just have to look for ways to create one for yourself to help protect you at retirement. Like I said earlier, people will not always be young and energetic and work all through their lives. So start to think about the future today.
Right. Start to think about the future today. Thank you so much, Abigail Utomi, Business Head, Asset Management, Nuremberg. Thank you for coming on show today.
Thank you for having me, Ladi.